expectation for the November CPI was for a gain of 0.3, and that would have represented a slight improvement over the 0.4% gain in the prior month. Well, the number came out at up just 0.1, 0.1%. That was below the low end of the consensus range, which went from a low of 0.2 to a high of 0.5. So this was good news as far as the market was concerned. The year-over-year inflation rate, which stood at 7.7 in October, was supposed to drop to 7.3 in November, and instead it dropped all the way down to 7.1. Again, below the low end of the consensus range, which went from 7.2 on the low end to 7.6 on the high end. So that was good news. Then, if you strip out food and energy, because nobody eats and nobody needs energy, so if you take out that part and look at the core, they were expecting an increase of 0.4, which actually would have been hotter than the 0.3 from prior month. Instead, we got just 0.2, again below the low end of the consensus range, which went from 0.3 to 0.5, and the year-over-year core, which was supposed to fall to 6.1 from 6.3 in October, fell to 6.0, this time matching the low end of the consensus forecast, which went from 6.0 to 6.3. Now, as soon as this number came out, stock market futures skyrocketed, but so did gold futures, and the dollar index tanked. I think on its low, it was down better than 1.5% on the day. It recovered some of those losses yesterday, but I think it closed right at 104 on Tuesday. Gold, which was up $30 pre-market, was up over $40 an ounce once the U.S. stock market started to trade. And in fact, when the Dow Jones opened up, it was up about 700 points, but it did manage to render all of that gain. It was down over 100 points at one point during the day. So you had better than an 820 point intraday swing. Now, by the time they rang the closing bell, the Dow was positive about $100, but a far cry from the 700 point rally that it began the day with. But the excitement was all about the fact that inflation came out lower than expected. Now, it's not that inflation is low. Sure, 0.1 would be a low rate if we had 0.1 every single month, but we don't. And of course, if people were struggling with a high cost of living in October, their struggle didn't get any easier with an additional 0.1% increase in prices. No, if prices were too high in October, they're even higher in November. What consumers need to get relief is a decline in prices. Now, of course, the Fed would say, oh, that's terrible, we can't have deflation. Well, if we have a huge increase in prices, what's so bad about having a decrease in prices to bring them back down? Remember, the Fed talked about inflation averaging. They wanted inflation to average 2%. Well, last year, inflation was 7.7%. The year-over-year rate of inflation in November is 7.1. It's probably going to end the year north of 7, which means we've got 2 years of inflation, which when added together represents a 15% increase in the cost of living. That is a huge increase, and especially when you consider the fact that it's probably double that, because the CPI is only capturing about half of the increases in consumer prices that consumers are actually paying. That is a massive increase in the cost of living. That is why so many people are moonlighting. And again, that's why we have so many jobs being created, because people can't pay the bills with one job. They now need second and third jobs to pay these higher prices. So this is not a strong labor market. This is a weak labor market and a weak economy where people are forced to work multiple jobs when they used to be able to get by with just one. They still don't understand that the days of low inflation are over, and we're living in an era of high inflation, and that is a complete game changer for the Fed. And the Fed has yet to come to terms with this new reality, nor has the market, because investors who don't understand that the game has changed, well, they're going to be playing by the old rules, and they will lose if they don't adopt their strategy to the new reality of high inflation and higher interest rates. Now, we still have negative real interest rates, but the nominal rate is higher and inflation is much higher, and more importantly, it's going to get a lot higher, and it's introducing another element of risk into the markets, because prior to that, investors were confident that inflation would stay around 2%. Once they have to acknowledge that it could be much higher than 2%, But how high is anybody's guess. That introduces a lot of risk that needs to be priced into financial markets that had been priced out when so many investors were lulled in to a false sense of complacency, and they actually believed that the Fed could deliver on its commitment, that it could fine-tune the inflation rate to such a precise degree that it could keep it right around 2% indefinitely. But the most significant market reaction to the better than expected inflation data was not the stock market. After all, the Dow couldn't even hold on to its big rally. The big news was in the foreign exchange market and the gold market, because even though the dollar didn't close on the lows, it still closed the day with big loss. The same thing with gold. Even though gold backed off its $40 high, it still closed the day about $30 higher, and more importantly, back above the $1,800 an ounce level. And as I've been saying, to the extent that we do get a Santa Claus rally before the end of the year in the stock market, it will be short-lived, because this is not a bull market in stocks. We're still in a bear market, but this is a correction within that bear market. In contrast, we are in a new bull market in gold. We're in a bull market in gold stocks, and I believe that we are in a bear market in the dollar